Risk disclosure statement. This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Level 5 Masters, and this is section 25. We'll further study about various type of gaps in this lecture too on bigger scale. Review. In the last lecture you learned about some of the myths of gaps. Then we went into the concept of true gaps and when they form. We covered the regular and extended trading hours concept. Finally, we examined the concept of pit gaps and how they are different from true gaps. Hopefully, by this point, you have begun to look at many different time frames in your trading. This is a necessity if you want to learn to trade gaps properly. You must learn to contextualize the gap based on what is happening on the daily chart. We will examine this concept first on a bar-by-bar basis and then in the context of where the gap is occurring on the daily chart. Prior bar relationship. It's very important you look at where the gap opened in relation to the previous bar. The odds of a complete gap fill vary based upon where the gap open is in relation to that bar. For example, if the prior candle was a down candle and now the market gaps above that candle's high, then there are two possible stopping points that might prevent the gap from completely filling. These stopping points are the high and the open, obviously. Here you can see different options. Here, if the market opens right here, so this is gap above the previous day high. If likewise gap above prior day high, this is a little above the high. So in both the cases you see this is a bullish candle, but this is a bearish candle, but in connection and relation with the prior bar we have to forecast few things which we'll discuss further. Likewise you see gap above close, but it's below the high, although this is the opening price, and this is high, this is low, this is closing, and you'll see this is above close, but within the wick, so this is below the high. Alright, so likewise you can easily be familiar with these formations as we've already discussed in candles. So this point we have to take care. Then in the previous slide we showed 10 different gap open relationship based on the prior bar. Each one of these different examples has a different probability of the gap being completely filled. This will be further modified by other factors we will cover in this section. Many traders don't even consider any of this information when attempting to trade gaps, and that's why they take the gap very easy. And in fact, they have challenges, successfully trading the gaps pattern. True gaps versus bit gaps. As we've already discussed, if still some of you don't really understand the bit, let me explain again, because most of the traders nowadays, those are not trading in the exchange. So exchange trading is generally called bit trading, although now most of the exchanges are electronic as well. So there are no more bits, these are electronic bits. But before, if you see some old pictures where there were circles and somebody is sitting inside the circle, that is bit. Somebody is sitting one step up, that is second bit, which represent different months. So overall you can say there is a gap between the US or any other exchange trading session, then there is some break and some products open after 1 hour, some after more time, likewise. So these gaps which we have to consider versus true. We just look at the concept of potential stopping points which might cause a gap to not completely fill. As we covered in the last lecture, true gaps produce space and only have these minor stopping points to consider because there is not any other overnight price action. That's why true gaps are easier to trade and generally fill more often. Bit gaps have overnight price action to also contend with which may prevent the gap from completely filling. You can understand this point because, as I explained, difference between electronically traded time frame and exchange traded. For example, areas of congestion that formed support or resistance may prevent the gap from filling. This is one point. There may be an additional overnight high or low that is different from the prior day high and low. That might be a potential stopping point because the reference point is changed, even the high is changed, low is changed, so the candle is changed. The best bit gaps also have overnight space to trade back into, in addition to the minor space aspect that we discussed in the prior lesson. Too many traders don't take the daily trend into consideration when trading gaps. For example, a market that has been trending up will have a high probability that gaps lower will fill and a lower probability that gaps up will fill, because anything which is against the trend is difficult comparatively. A market that has been trending down will have a higher probability that gap up fill and a lower probability that gaps down fill. Which leads us to the next topic of defining different types of gaps based on the daily charts and trends. Now this is a very important slide. You should listen it multiple times, especially the type of gaps we are now going to discuss. Just as it is important for the trader to reference the gap open in relationship to the prior bar, it is also very important for the trader to refer the gap in relationship to the recent price action on a daily chart. Remember, we must have to see the daily charts, and rarely we go for shorter time frame as far as the gaps are concerned, because one complete bit traded session and the difference of electronic session is more calculatable, and it makes more sense on daily. Gaps can be put in the following categories based on both the relationship to the prior bar and the overall price structure based on the daily chart. These are common gaps, breakaway gap, continuation gap, reverse trending gap, exhaustion gap. Keep in mind that not all gaps are easily categorized, especially for the beginning traders. So remember these gaps. These are 5 common gaps, breakaway gaps, continuation gap, reverse trending, and exhaustion gap. Let's now further discuss these in detail. Common gaps. Common gaps are generally smaller gaps that more often than not occur within the range of the prior bar. They occur within a daily area of congestion or consolidation. They are generally small to medium-sized gaps. They have a high probability of completely filling, not always on the day they occur. But they are difficult to trade since they are smaller and risk-reward ratio is generally less than 1:1. So here you can see those candles which are highlighted in light blue are having some gaps which are common. If you watch any gap, for example, this was the opening price of this candle, made a low here, then high, and then closed here. After that, the next bar open up here. So this is the gap. And likewise, you can see all have gap, but this is small gap. Likewise, here in this case you see it's a big emotional candle, then closed here and then open here. So this is a little gap as well. This gap was filled, right? This gap filled. So most of these gaps fill. These are the common gaps. Now breakaway gaps. Breakaway gaps are just as they sound. They break away from area of congestion or consolidation. Breakaway gaps can either be up or down, depending upon the trend. If they are very large, they rarely fill on the day they are created, and sometimes only partially fill in the next few days. Here, one thing which you must have to consider as a third factor, that is the time frame, how much time a gap is taking to be filled. Because it's not useful if, for example, it's filled after 1 week or 2 weeks. Nobody can hold the position till that, because stop loss point could have occurred well before that, so it no more remains beneficial. We'll see this in coming chart as well. Many times the gap through key trend lines or major support or resistance or any significant level or some huge technical or sometimes fundamental reasons. They are not a gap a trader wants to trade as a possible gap fill, but the trader should look for trades in the direction of the gap for the daily trend to continue. And we will discuss this in the next lecture, how to trade these gaps. This is an example of breakaway gap. Market crashed here and it was already in bearish trend, and you see it closes here and opened here. So it's a huge gap which is more than average daily move if you see the ATR, and you can see. Another example of, here you can see a it's a huge gap, it's a breakaway, and partially it's filled till here, which is not even 1/3, but again it went up in the direction, so it's not filled. Continuation gap. Continuation gaps are the gaps that continue a strong trend. These gaps also have a lower probability of filling either on the gap bar or within the next couple of bars. Traders should not look to trade these gaps as potential gap fills, but look for continuation trades in the direction of the trend. Continuation gaps are very similar to breakaway gaps, but they continue a move rather than start a move. And it could be very helpful if you remember when we studied R zones and the continuation. So this is another reason which you can add. As we discussed multiple times, more and more reasons you have, more is stronger, and the trade plan, and it gives you the confidence that you have a solid trade plan. So this is the example of continuation gap, and none of these ever filled. It was strong support, this broken, it's a gap, next day this is huge gap, and next day there is continuously another gap, and again another gap, and again this is a small gap. Then market remains in consolidation, and even then after making a rotation zone, if in conjunction with other studies of moving averages and R zone, once we will see multiple aspects, we will have maybe another entry or continuation trades pattern, as we have discussed, to further increase profit, if especially it's a multiple target trade. And so these could be helpful for you in a number of ways if you combine with whatever we have studied so far. Reverse trending gap. A reverse trending gap is a gap that is in the opposite direction to a trending move. For example, in an uptrending market, a gap down, or in a downtrending market, a gap up. Sometimes these happen during short consolidation periods in the trending move or during short-term corrective patterns. These gaps have a very high probability of being filled. These gaps occur many times when the equity markets are trending strongly and have a very high probability of filling in the equity futures. So here you can see multiple gaps. It was obviously a breakaway gap, it's never filled, keep on continuation, and here it was some retracement of the move, then again start moving up, but this area was obviously potential resistance that time. There could be some other factors and indicators if you will plot them. So here you can see once it start, this one, this is the gap which is in the reverse direction. It was candle was down but open up. Likewise here, all these are the example of reverse trending gaps, and all of these are filled. If you see, it filled next day, next day, next day, again next day. So these are high probability filling gaps. Exhaustion gaps. An exhaustion gap is a gap that occurs at the end of a strongly trending move. They are in the direction of the trend. They occur many times when the price action is far away from the 21 EMA or after the price action has gone vertical. They have mixed probabilities of filling depending very much on whether or not they become part of other price action patterns. For example, there can also be other gaps around them that produce island tops or bottoms that signify the end of a trade. Many times the beginning trader, they think an exhaustion gap is actually a continuation gap, and apparently it looks like, until price action strongly reversed. So as we have studied, if you remember, in volume lecture, in initial lectures sessions, so volume is one of the factor which can help you in indication. If the volume is increasing, market was going up and up, and there was gap, but suddenly the day when this gap occurs, volume drops. So it means market is now almost exhaust, going up or down, whatever the trend could be. That could be one of the indications that you should consider it might be a reversal. There could be some piercing pattern, some doji, some morning star, some other indicators will be coupled up. Here is a live example of this. You see, there were multiple gaps. This gap, this gap, this gap, this gap, this gap. So market is continuously trending up from here. A lot of gaps, and it was somebody could take it as a runaway gap. But here, market close bullish, almost near the top, day high, and then you see where it opens. Reversed all the gap same day, and then very next day it's again coming down, which confirm it was exhaustion gap, and then moving average also broke down, and you see huge gap very next day. There are multiple reasons. If you draw a line here, support was also broken, moving average also broken. If you draw rotation zone, you will see there is also rotation. So likewise, you will always find many reasons, many logics to give you a rational trade plan, and all these will really help you out. So this type of gap is exhaustion gap. Gaps and market bias. Another reason that gaps trade differently in one market to another can be due to market bias. For example, down gaps fill at a higher probability than up gaps in the equity market. This is due to the natural bias of the equity market to the upside. On the other hand, there is no bias to either up gaps or down gaps in the Forex market or futures contract based on the Forex market. This is because there is traditionally not a bias to an FX pair, and also there is very little gap in the trading time as well, and there is no paid trading involved as well. A gap one way is just one currency getting stronger versus the other currency. Okay, pit gaps and time of day. As we have previously discussed, pit gaps are gaps based upon charting the regular trading hours or pit trading sessions. Trading has still happened that produce that gap. It is just not represented on the gap chart. Looking at the extended trading hours or overnight session chart, the trader can see the price action that caused the gap move. Depending on the time of the day that produced the price action that created the gap changes the odd of a gap fill. For example, price action after the daily market close that occurs either in the early morning or early European session tends to have a different probability of gap fill instead of price action in the pre-market open of the US session that caused the gap. This varies by markets, so the gap trader will have to research this aspect of with gaps. And always remember, whatever we have been studying, you should better find a couple of more reasons before making your decision. And finally, of course, reward to risk ratio and other parameters you have to find as well. It's not a standalone indicator. There are some standalone indicators as well, sometimes the gaps as well, but it's better still you could find more and more reasons to go for the trade if you have proper brainstorming habit, develop it. The size of the gap matters. The larger the gap, the lower the probability that it will fill on the day it is created. Many times these are breakaway or continuation gaps, and the trader should be looking to trade with the gap instead of trading for a gap fill. These large gaps can provide good continuation trades, especially if the gap only fill to key Gann levels. These large gaps can provide good continuation trades, especially if the gaps only fill to key Gann levels. This is important. We will cover this concept more in the next lecture, and you will have that idea. Size of gap. Again, one way to classify gap sizes is in terms of the ATR. This is best done using at least a 20 period ATR. Generally it's of 14 days. So in this case, if you have to watch for the gaps, you can change the parameter, go to the average true range instrument and modify it to 20 periods. Small gap can be defined as a gap generally less than 50% ATR. A medium gap can fit in the category between 50% and 100%. A large gap can be defined as a gap over 100% ATR. For example, if the daily ATR is in gold, for example, is 10 points, and then you see a gap of 5 points, so it's close to medium, and if it's more than that, it's considered a large gap. Generally, it varies product to product, and especially if we take 20 days, it means it's almost 1 month's average performance. So if one day is behaving abnormally in whole month, so it gives you more idea that this is something unusual. These classifications should be fine-tuned based on research of the gaps in the specific markets you trade. Find some example now assignments for your practice. Find some examples of the different kind of two-borrower relationship gaps. Find examples of the following gaps based on the daily price action: standard or common gaps, breakaway gaps, continuation gaps, reverse trending gaps, exhaustion gaps. Summary. In this lecture, you learned about the relationship between the gap open and the prior bar. You also learned about the different kind of gap categorized based on where they occur on the daily chart. We also covered some other aspects that can change the probabilities of a complete gap fill. Have some practice, and next will be the